Good morning, everybody. Welcome to the Reserve Bank. Welcome to our December monetary policy statement. I'm Alan Bollard. The Reserve Bank this morning is leaving the official cash rate unchanged at 2.5%. The New Zealand economy continues to recover, but there's still some uncertainty about the durability of this growth. Our picture this morning has a story with the global economy rebounding. There's really two parts to it. Firstly, we note that Australia, China and other parts of emerging Asia are growing significantly, and we expect that continued growth solidly into next year. The other part that we note is some of the more major developed economies in the Northern Hemisphere, and there the picture's more mixed. It's now a story where they're all growing, but it's just not clear how sustainable that growth is. Their financial sectors are still impaired, and their economic activity is still very reliant on policy support. The New Zealand picture, well, the New Zealand economy continues to recover. It's reflecting improved world growth. It's reflecting stronger export commodity prices, increased government spending, and also now some signs of housing strength. But we do note there's a key uncertainty in there, and that is just how much these higher house prices we're seeing are likely to be eventually reflected in stronger consumption. Currently, credit growth in the household sector is quite subdued, suggesting that household spending remains very cautious. On the business sector side, well, business confidence has improved, but actual business spending still remains very weak. And the high New Zealand dollar has continued to limit the scope that we've had for a stronger export-led recovery. We do note that the current account deficit is expected to correct significantly in the short term, but then widen again in future years. Annual consumer price inflation is now expected to stay below 2% until early 2011, and we believe it will track within the target range over the medium term. This economy is being assisted by both monetary and fiscal policy support. As economic growth becomes more sustained, fiscal consolidation would help reduce the tightening work that monetary policy will otherwise need to do. If the New Zealand economy continues to recover as projected, then conditions may support starting to remove monetary stimulus around the middle of 2010. In the meantime, the recent tightening that we've seen in financial conditions, it's been a tightening that's been driven by higher exchange rates, by increased long-term interest rates, and by the wider gap between the OCR and bank funding costs. That recent tightening in financial conditions, in our view, reduces the need for any more immediate action. Thank you, ladies and gentlemen. That's the end of the formal statement. We're open to questions, and to assist, I've got Dr. John McDermott, Assistant Governor and Chief Economist, and Dean Ford, Head of our Forecasting. Are there any questions for us? Brian. Just one moment, thanks. Can we remember we're webcasting here?
Why did you feel it desirable to alter the guidance as the timing of the start of a tightening cycle?
Well, we have been unusually explicit over the last number of statements because we felt that we were seeing financial market conditions that could be getting ahead of things. We have noted the financial markets take note of that. We're now actually this time seeing an economy where some of the background conditions are just slightly stronger, and we believe we're back to a situation where financial markets will themselves make up their mind about if and when tightening takes place. We're being a little bit less explicit about it now. I said if and when, I should say how and when. Go ahead.
You've got a stronger forecast for household consumption, I think, than 3 months ago, and yet you think the recovery in house prices will run out of steam, and you're not sure to what extent that will flow through to consumption in any case. So what is that stronger private consumption track based on then?
Well, the stronger household consumption track is based on some other features, such as clearer view that the labour market looks like we're nearing a turning point, and we believe a lot of people will feel a little more secure about their jobs than they might have in the past. We are seeing people rethink their household balance sheets, and we've seen a little bit more pressure on prices in the housing market. But as you rightly say, we're not expecting that all to feed through in a traditional sort of way into consumption. We're seeing quite cautious households. We're seeing that credit for lending on houses is still very constrained. We'll be watching that closely. But at the minute, we're not seeing households plough back into spending. Actually, they're still continuing to reduce their debts and improve savings, or at least reduce the rate of dissaving.
Governor, could you elaborate a little bit on the turning point in the labour market? You say it's looking like it's reaching a turning point.
Sure. Can I ask John or Dean if they'd like to go into the detail on that?
So we've seen over the past 6 months or so employment intentions have improved quite a lot. You'd expect that the improvement we're seeing in the broader economy should actually see firms getting more confident about hiring. An important thing though is that as we saw the economy slow, firms, where possible, actually retained workers. So they cut labour costs by reducing the number of hours they hired, or where possible trying to maintain wages. You'd expect as the economy picks up, rather than having to go out and hire more people, firms could just be able to increase the hours of their existing staff. So there may actually be some delay in how the turn in the economy feeds through to the labour market. But you should expect that as the economy improves, you should see the unemployment rate soon peak.
James.
Dr. Bollard, were you particularly surprised by the strength of the housing market in the last few months, and how do you see that unfolding in the coming year?
Yes, house prices didn't drop quite as much as we expected, and in addition we've seen more pressure on rising house prices over the last couple of months, but interestingly the data out yesterday suggested that's not necessarily going to continue that strongly. I think it is an unusual time in the housing market. You've got still very little supply on the market. We've had unexpected gap between demand and supply, unexpected in the sense that net immigration increased quite a lot. New Zealanders didn't leave as fast as what had been expected through the recession. And those are fundamental drivers, and in a situation like that you'd expect and want to see the housing supply respond. It's taking a while to respond. We're only now starting to see consents and residential investment show signs of picking up. So that's been a slower response, and actually there's been a distinction this time between house prices on the one hand and credit, investment and sales on the other, but we expect that to correct over time.
Are you happy with banks' credit lines to business at the moment?
You'll recall we were concerned earlier this year that a lot of businesses were reporting to us that very difficult borrowing conditions, and in addition that banks were putting very, very tight conditions on banking covenants and other conditions of lending. We're hearing less of that now. We actually instituted a credit conditions survey to get a better feel for just how that was changing. At the minute, we've got a story whereby business lending has slowed, or rather the rate of growth in business lending has just slowed right away. But that's not being accompanied by so many complaints from the business sector. It more seems to be that businesses actually aren't looking for funding at the minute, as well as banks not driving out there to push it out.
Dr. Bollard, there was a fairly clear message to the government about both fiscal and tax policy. Have you been talking to them directly about that, and have they proved receptive to your message so far?
Yes, and I hope so. We continue our normal relations with the government, which is that we will discuss our forecast with them after we've completed and started to print our forecast, but we don't discuss our monetary policy decision with them. That's always been the case. And as part of those discussions, we make it clear that we are forecasting on the assumption that the forecast consolidation on the fiscal side is actually going to happen. And we believe with a slightly stronger economy, that's quite important because there is ultimately a trade-off between getting fiscal consolidation and having to have higher interest rates than you might otherwise expect.
But you seem to be calling for more restraint than was indicated in the last year's.
We're repeating our calls from last time. On the tax side, well, we do monetary policy, not tax. We know that tax is a very complex area and there are a lot of different government objectives drive it, and that's as it should be. But we have always made the point quite clearly that we are looking for a more neutral tax environment when it comes to householders with funds deciding whether they will consume or save, and if they're going to save, how that might be invested, whether it's housing or elsewhere.
Dr. Bollard, in the monetary policy statement, there's a forecast increase in the non-tradable inflation rate to nearly 3%. Why do you think this is happening, and how sustainable is that?
The key factors were an improved global outlook, which also feeding through to improved exports, particularly in prices, particularly dairy prices. That gives more confidence in the economy. As the economy recovers, that transmits through to how firms and businesses can pass on prices. So there's a revision of about 1 percentage point to non-tradable inflation. You see it's reasonably sticky around that for the next 3 years.
Can the economy sustain a non-tradable inflation rate at 3% for the long run?
Well, it has for quite a long time back in the past. It's not necessarily how we would like to see the economy. We'd like to see non-tradable inflation pushed right down into the sort of zones where tradable inflation has settled. But it has been a story in New Zealand for quite a long time now.
And also the overall target is headline CPI, and when you measure both the non-tradable and tradables, we have a picture of the next 2 or 3 years with headline inflation running around 2%, and the non-tradable part of that is probably at average or slightly below average over what we've seen in the last 5 years.
Well, could I clarify in your comments on fiscal consolidation, do you expect the rate of government spending to slow down or actually to see significant cutbacks next year?
Our forecast is predicated on the budget numbers, this year's budget numbers actually feeding through for next year, adjusted by the slightly stronger economy that we are forecasting and the slightly different nominal picture, which is important for the tax take. Is that a fair summary?
Are you happy with the level of the New Zealand dollar, and do you think it more accurately reflects the fundamentals of the economy now, say, compared to at the time of the last rate review at the end of October?
It's looking a little bit less out of line than it has looked over the last few months, and that's because we've seen we've seen dairy prices, other commodity prices pushing up, impact on terms of trade, and we've also, of course, seen the trade-weighted index starting to come off a bit. We are watching with interest as to whether or not we could be starting to see a change in mood in the international financial or the international FX markets, where there's been this dominating view towards more risk and more portfolio rebalancing out of US dollar. There's a few, at this stage, early signs that might be changing. We'll watch that quite carefully.
Could I check on, in terms of your outlook on the ETS position, are you incorporating and anticipating some rise in prices as a result of that, and when does that come through?
Yes, that's a good point. Thank you. Our forecasts do not incorporate the price or any other effects of emissions trading scheme. We'll be doing that in our next forecast. We have a broad understanding of likely ballpark effects. We think they're likely to be significantly less than with the previous policy design for emissions trading scheme, but nevertheless countable. They're not in this forecast.
Dr. Bollard, you're forecasting annual house price inflation of 12% by the March quarter. Well, what makes you think that this won't flow through into more debt-fueled consumption spending? Why is it different this time, do you think?
We think it's different for a number of reasons. One is that we think New Zealanders have taken some lessons out of the global financial crisis and what they saw as some vulnerability in house prices. Secondly, from that, they have also taken a view that they were getting themselves quite indebted, and in many cases we're seeing an attempt to rebalance household portfolios with less debt. And thirdly, if we just look at the credit numbers, they are very, very restrained at the moment. So we'll keep watching those quite closely, but at the minute we're simply not seeing the signs of a debt-fueled asset bubble here.
Just one more on the Reserve Bank of Australia, likely to, according to markets, to increase its official cash rate to over 4.5% by the middle of next year. Would you be comfortable with such a big gap opening up between Australia and New Zealand over the next year if you keep the official cash rate on hold at 2.5%?
Well, I mean, as ever, we will not comment on what another central bank is doing, but you can be sure that we watch quite closely what is likely to be the profile of other central banks' interest rates going out through next year, and we're taking that into consideration. So simple answer is yes.
I wonder what you made of the Labor Party's decision to walk away from the long-standing consensus on the monetary policy framework.
Well, we've got no comment on that, other to say that we're confident that inflation targeting monetary policy, as we're carrying out and in view of some of the changes we're putting into place following the crisis, can work.
Governor, are you happy with the bank's mortgage lending rates?
The bank's mortgage lending rates are currently reflecting increased cost of funds, and cost of funds that's remaining quite stubbornly high, whether that's retail or from international markets. So we have less concern about that than we did when we expressed early this year some concern that they hadn't passed on some of the interest rates. So we've got no particular concerns about those at the minute. They are reflecting real costs of raising funds internationally.
Hello. Yes. Is this? Can I get you just to clarify the wording around the timetable, as you see it, for raising the cash rate? Are we to take it that the change in wording from keeping at current level until the second half of 2010 to around the middle of 2010, is that saying you expect to start raising the rate earlier than you did at the end of October?
Well, luckily in this room there's a whole lot of media experts who are expert at interpreting words. Some of you even have English degrees, I know, so I'm confident that you're going to be able to interpret that one yourself. Are there any other questions?
So are we to expect a happy and prosperous new year?
Thank you, Barry, for that point. Finally, on a more personal note, since this is the last press conference of the year, I would like to thank you very much for your help and cooperation through the year. It has been one amazing year, as you all know. At the beginning of this year, we were seriously worried about the financial system and the state of the economy, both in New Zealand and internationally. it's with some relief that we see much more secure conditions as we go into Christmas time. I am aware that at the beginning of the year, when New Zealand was in such a vulnerable state, actually it would only have taken one of the major media people looking for a fast headline, acting on rumour, or passing on something irresponsibly to have sparked off some real problems in our system. That we were concerned about that. That didn't happen. You all, I felt, acted very responsibly through that, and for that we would like to thank you. Finally, it's not a forecast, it's a wish. Have a Merry Christmas, Barry and everybody else. Thank you very much.